Good morning, guys. Welcome back to Finance with Uchit, and today we're gonna cover TeamLease. I think TeamLease is one of the best turnaround stocks to buy in India today, but this is not financial or any kind of advice. This is just an educational video. So let's get into it. So before we go to we dive deep in the finances, I would like to go through the technicals because if because usually finance takes more time, going through the finances takes more time, and if you just go through technicals first and see if the company is really worth buying right now, it would save us a lot of time and it would be more efficient. So right now we can just mark the lifetime high. It's around here, around 5538. The current price is 1211. So it's 78% down from the lifetime high. And it just broke the support right here. This one. This one was a really important support, but it's on a support right here, around right here. This one. And now it's probably likely to bounce back, but we can't just buy based on um, technicals alone, so we'll have to see other things like the financials and all. Right now, the volume is okay. The 52 week, it's on the 52-week low. It's nearly there, and it's below the 200-day moving average too. Okay, so we can see that it's a really good stock right now. It's really low. Of course, there's a big risk that this could further go down even more because I don't see no bottom here. So that's a big risk. Let me see if there's a trend line here. Nope, there's no trend line there. What about here? I don't see no trend line here too. So yeah, there's no trend line there. There's only a support that's here, and it might break it because this was 10 years ago. The support was made 10 years ago. So that's a that's a bit of a red flag. But now we'll go to the financials to see what's actually going on. So I'm using screener.in to look at this. And before we go through all of this, the ratios, I would just like to read the about section because this will give us a overview of what the business is. Okay, so basically TeamLease Services provides employment related services. It provides solution for staffing recruitment, payroll processing, and regulatory compliance. Its major business segments are general staffing, specialized staffing, and HR services. So, in short, this company provides employees to other companies. So, it's a B2B business. Okay, so let's move on to key points. So, the company is a leading player in the recruitment industry, or it offers a range of solutions for general staffing and allied services. This alone provides 93% of the revenue. The company offers staffing solutions and temporary recruitments and payrolls. The segment revenue grew by 22% YOY in FY25, driven by a 16% raise in headcount. Okay, specialized staffing services. The company offers IT staffing and telecom staffing solutions. The segment's revenue grew by 2% YOY in FY21. Other HR services. The company offers regulatory compliance training, a job portal, education technology, and SaaS based compliance solutions. It has introduced a degree of apprenticeship pro- program to offer hands-on training to apprentices. The segment revenue grew by 21% YoY in 2025. Okay, so let's move on to headcount now. General staffing. In general staffing, there are around 300,000 people as of Q3 FY25 versus 250,000 people as of the previous year. In specialized staffing, there are approximately 6,700 people, and before a year before, it was 7,600 people. This is majorly because of weakness in the IT business, and most of the specialized staffing people go to IT, and that's why the headcount decreased. Degree apprenticeship. So there are approximately 47,000 people as of today, and there were approximately the same amount, 43,000 people last year. So it has grown a little. That's good. Okay, now let's move on to clientele. The company provides HR solutions to 3,900 plus employers and has hired over 23 lakh people. That means around 2.3 million people in the past 23 years. So around 100,000 guys every year. It serves large, medium, and small clients across three key areas: employment, supporting 3.5 lakh associates and trainees; employability benefits, 7.5 lakh students; and e-workforce, serving over 1,000 employers. In FY24, the top 20 consumer accounted for 43% of the total revenues. So it's pretty concentrated out there. That can maybe become a risk, but we'll cover that later. Network company. The company has a network across 7,500 plus locations in 28 states. So basically, um, all of India. It covers all of India. Acquisitions. Now this is an important point. In Jan 2025, the company signed a SPA to acquire an 80% stake in Ikigai Enablers Private Limited, which can help to expand the IT staffing business in Singapore and the Middle East. It also acquired a 90% stake in TSR Darashaw and 30% stake in Crystal HR in December 2024. Now, the acquisitions and all, this can become a major problem because now the company is growing inorganically through acquiring companies. And this can become a major problem because after it has done all these and it has, then how will it grow? So, this is a major risk factor for us too. Now let's move on to the ratios and financials. Okay, so since this is a turnaround stock, I think it would be fair if we go through the reasons of the stock actually dropping 78% first, and then looking if the reasons are gone or not. Because if we jump straight into the financials, then it would just be inefficient if we just jump straight into financial and everything is good, but we just find out the reason of the stock going down is, let's say, a fraud. So then it would just waste our time. So let's just go through the reasons first. Okay, let's go back to TeamLease and let's see when was the last time I made. It was made on 11th. It was made on 11th October 2021. Okay, and before that, it nearly 4x'd itself within a year and a half. And now let's see what Nifty did. Nifty. Hmm. Okay. Height. Good. Okay. So when was this made? This was made on October 19th, 2021. So you see, these were really close. What about Nifty IT? CNX IT. CNX IT. Okay. Okay. So yeah, CNX IT made that too. So actually we can find out in which indexes is this on. So it's in BSE services. So we can go look there too. BSE services, if it's here. Mm, yep, BSE services. Mm, okay, and then it doesn't show us the data. So anyways, you get the point. Okay, so when TeamLease fell, there was a major reason was the market was correcting too. So that's why team needs fell, and this is what happens in these turnaround stocks. Most of them, if you see, they go down because of the markets. First there's a huge rally. First there's a huge rally, right? Yeah. So this is what happens in turnaround stocks. I've noticed this. So first there's a huge rally, the stock goes above its intrinsic value, and then reasons start to form and markets go down. But the stock, since it was so since it was so overvalued, the stock crashes, and it crashes more than it should, and then it bottoms out, and then it turns back, and then the cycle continues. That's what I've seen happening in many of the turnarounds. So I think this is the same case with this too. So that's the first reason of why this went down. Now let's look at the profits too, so we can find out, is was there a thing there too or no. So let's go to screener again, and we can see here that in March 2021 the sales dropped around 6%, and then the profit was below the lifetime high too. And in March 2022 the profits were way below this, they nearly halved this, and then but the sales increased, that was good. And then there was this exceptional loss too, so this made it even worse. We can actually go back and see, okay, there's none there, so we can go to their investor thing, and then we can earning call, financial reporting, quarterly results. We can go there, and then we can just go back in time, and we can just go to this, open link in a new tab, open link in a new tab, and then this too. Hopefully this loads on time. Okay, yeah, it loaded. So this was our income from operations, total income, and then our total expenses were these, and then our profit was only 22 cr. Okay, and our net, okay, so this was a net loss. We had a net loss here. So you see things here, weren't going very well. And we can go here too if you want. I can revenue. Okay, this increased a little. Profits before tax were in the positive, and profits after tax are positive too. So you see some quarters there had a really big impact on the performance. And also by late 2022, I management began warning that global macroeconomic headwinds were impacting specialized IT staffing, a high margin segment of the company. So that impacted them a lot too. Also, like I showed you there, in November 2022, the stock dropped 18%. Let me see if I can find that here. Yep, right here. After that, so these 2 days, and after reported earning missed analyst expectations and raised fear that the company would fail to meet the full year EBITDA guidance. Also, the ratios were deteriorating too, as you can see here. Should I unlock this? No. Okay. As you can see, the ratios were deteriorating here too. The ROCE went down, and the ROE dropped from 12.2% to 5.7%, and the ROA declined from 6.6 to 2.8%. In cash flow, the net cash flow swung from a positive of 247 crores to a minus of 108 crores. And as you can see, the free cash flow was in negative too. So basically, the company was in a loss for this year. And that was a major reason why it fell this much. Okay, so let's summarize the points quickly, okay? The first point was, firstly, the market went down. That's why the company went down. Secondly, there was some industry headwinds, and there was weak 2022 earning reports, and also the ratios deteriorated. This all led to the fall of this company. Okay, so now let's go through TeamLease's financials. So first, let's go up and check what's going on. So right now, TeamLease has a market cap of 2,000 crores, and it has a P of 15. So if we put in $1 right now, it will give us the $1 after 15 years. Okay, and the ROCE right now is 12.7, and the ROE is 12.2. The current ratio is 1.24, which is okay. I mean, sure. Sales growth is not. Sales growth is basically 10%. Price to book is 2.11, which is okay, which is really good actually. And debt to equity is 0.13. I really like that because that means insolvency risk is nearly over. Hmm, the quick ratio is 1.24. This is also important. I'll go over that soon. And intrinsic value, I mean, if you want to check this, you can, but I don't really check this. And they don't pay dividends. That's a con, if you would like to say, but honestly, it's okay for me. So I showed you the stock's performance in the technical analysis section. Now let's go to the PE ratio. So the stock's median PE is 48. Okay, let's note that down somewhere. It's 48, 48.7. This will be important later. and right now the P is 15. Okay, so 15 divided by 48, no, sorry, 48 divided by 15, 48 divided by 15, 48. So that's 3.2x from here. Okay, so if the stock had to go back to its medium P, it would have to go 3.2x. That should I just convert it to, yeah, I should just do that. So number of share 1.61, 1.68. So 5015 times 1.68. This will give us a total market cap 84.25, 85.25. No, 8,425 divided by, what's the total? Sales 133. 133. This will give us 63. Okay. How about we do this? Simple. 133 times 48.7. So yeah, it would have to reach the market cap of this 6,077. Sorry for the calculation errors. Divided by 1.68. 1.68. So the stock would have to go to here. The stock would have to go here to reach that. What's the price? Let me just show you that. It's 38.37. So we'll just mark it with this. Okay, that's the P price. That's the P valuation if the stock would correct to the P. It would probably be more, because if you see the earnings trend, the stock is growing consistently, so it will probably be more like here around the lifetime high. But again, this is a conservative thing. This is a conservative this is a bear case scenario basically. If you really, it would at least double from here if it really had to actually. Now we'll go to EV to EBITDA, and then we can just do this again, 33.6, and then we can just continue with that. So that's really low from that point. Let's just take 5 years actually, and then this is 6, but right now currently it's around 2.11. So that gives us upside too. And this is zero point 0.5 right now. Right now, what is it? Right now it's zero point 0.2. So yeah, basically the sales are bigger than the company's market cap. That's what they're saying. We can compare this to the peers too, to our peers. So this basically shows us the median for all these companies. So it's 20, and then we would just do what we did here, 20 times 1.3 is 133, that's 2,600, and then 660 divided by 1.68, so that would be 583, 1583. So this would be our bear case scenario here, and then we'll just go. So that's a 30% upside still. And as you can see, these guys are super overvalued. WeWork, I can go on a whole roast video of WeWork, how it's a really bad company, but I won't, of course, because you know I just don't wanna. And then we can see the average market cap to sales is 2.59, Right now, Team Leases is 1.017 or something. And I think Team Lease has the highest sales in this whole thing, even bigger than that's even bigger than these guys here, International GE and all. Mm, and then we can go down to the quarterly results, and we can see that's the highest ever results too. Of course, it's a low margin business, that's why it shows it has 1% operating margin, but you don't have to worry about that because that's consistent here. Of course, it went to 2%, but now it went back to 1%. So it's kind of consistent here, so we don't have to worry about that. And of course, the sales are highest ever quarter on year on year. Quarter on quarter is second highest, but it's okay. I don't mind being that. And then we go back down. So let's look at the past performance first of all. So as you can see, the company is consistently growing, and it was so the company had only one bad year where the sales dropped. Otherwise, it was consistently growing all the time. And right now, it has lifetime high sales too and lifetime high profits. Let's just check for other income things because sometimes they mess up things. And here we can see compounded 10-year growth for sales is 19% and profit growth is 13%, but the stock CEGR is really low. This creates a value opportunity too. Usually this means the stock can go back to its normal and mean revert. And then we go to balance sheets now. Okay, let's read the balance sheets now. Okay, so let's go to the balance sheet and let's see if it can survive a stress test. And I'll show you my thinking too. I'll give you a sneak peek on how I think about these and this and all. So as you can see here, our total cash, you're looking at our total cash is around 309, and our total debt, we're just going to look at our debt is 128, so we can pay our debt with our cash right now. We won't even have a problem with that. Okay, and then our total all our other liabilities, I'm not including shareholders equity because that's not liabilities technically, that's just shareholders equity. So you're just counting these as liabilities, and all of these are assets. And liabilities plus shareholders equity usually it should always equals assets actually. So and then from that we could basically pay off all these other liabilities with our current with our current assets, so we won't even have to sell our fixed assets. Okay, so now if a company has a lot of current assets and doesn't have a lot of liabilities, what I think of it is, let's say if a hedge fund would buy this whole buy Team Lease out, and they would just pay pay off all the liabilities, what would happen? They would basically recover their money in around 10 years. Okay, that was my calculation like 1 month ago that I did. Okay, so after 10 years, after they recover their money, and this was a conservative approach that I used, after 10 years, after they recover their money, they would basically have a business that was purely profitable, and they would have a free business. They would, so they won't even need to worry about it anymore. They would just let it sit and manage it really well, and it would just generate them pure profits. So this is what I call a essentially a risk-free company. uh, but it's not risk-free, it's not really risk-free, but I call it that. And this is where you get really good value opportunities in these type of companies, because they have low debt, they have a lot of current assets and probably a lot of fixed assets too. um like it's 50-50. They can have a lot of usually it's asset light. Usually it's an asset light business that they're operating, that's why they have a lot of current assets. So it's basically a really good turnaround stock if it can pass that stress test. So let's just conclude this. So we can see that they can easily pay off their liabilities from their current assets. They don't even need to touch their fixed assets or investments. And now let's move to the free cash flow section. Okay, so now let's move on to cash flow analysis. Okay, so important thing in this is that profit from operations should mostly be, or it usually should be higher than the net profits shown here. So we're just gonna check that if that's true. 153, 133, and then the 121. Okay, that's good there too. 147, 39. So that's good there. So yeah, we just check the net operations, like net. We just check that from there, and then we go to free cash flow, and we see if the free cash flow is positive or negative. Too much negative free cash flow can be a problem. So we just check it here if it's normal or if it's good or no. It's good. I like it. So and then we can go and go deeper in this, but we don't need to look at proceeds from borrowing, all that. It's just accounting stuff. We don't need to look at that really deeply. We can look at this: investments purchased, investments sold, but we don't need to look at it too deeply. We can go and look at this to see the trend if it's increasing. So usually trade receivables should increase at the growth rate of the sales. So if the sales are growing 10% year on year, then they should grow 10% year on year too. So we'll just see if that happened or not. I'm pretty sure that happened. Yeah, so sales doubled, but this didn't grow that much, which is actually good, because trade receivables means that you don't get the money, but you're gonna receive it. So that's good. And yeah, that happened because debtor days went down, you see. So that's why trade receivables um happened that way, which is good because this makes the company more efficient. Um, yeah, and then we can go deeper in the valuation section if you want. Okay, so before we head to the valuation section, let's just cover risk first, because risk is really important, and we should understand that before doing the valuation and concluding our research. So I just opened a couple of this is the annual report of TeamLease, and this is Crystal's rating for TeamLease. And we can go down to the weaknesses, and I think I think it's the weaknesses too. Yeah, I'm just gonna read this section: intense competition in general staffing and risk stemming for inorganic growth. So that's what I told you before. The staffing industry comprises of several organized players, in the domestic market, there are also several unorganized players that have regional presence and offer services at low cost, resulting in intense competition. This results in price pressure for organized players who have to incur large over overhead to maintain the quality of the services and the staff. Furthermore, there is intense competition in the general staffing segment, from which TLSL derives around 90% of its revenue, and markup in the segment is low at around rupees 670 PAPM, PAPM as on December 31st, 2025. The operating profitability therefore remains modest. The company plans to move from a fixed markup to variable plus fixed markup to improve its profitability and the market acceptance for the same for it. Okay, so this basically says that there's a lot of competition in this space, and the company has to move to a different um different strategy to to compete in this with good margins. Now let's head forward. As the business involves engagement of manpower, most players of this industry face high attrition driven by intense competition among players to poach trained manpower. Issues relating to workforce ability can adversely impact relationships with clients. Therefore revenue flow, however, the mitigated this is mitigated by the company's strong market position. So yeah, I do think that this company is basically the market leader of its segment, and that everyone everyone knows that this company is a market leader, and that's why the clients don't go away from this company easily. Okay, now let's move forward. Additionally, TLSL has grown through the series of acquisitions since IPO in 2016, expanding into specialized staffing segments such as IT staffing. The company has acquired several companies, including this in the past, and also has picked up stakes on DTR, Darashaw, and Wallet HR and Ikigai enablers. In fiscal year 2025, while acquisitions have helped TLSL scale up, they also pose irrigation risk, integration risk, and funding challenges. The company is likely to continue growing through inorganic expansion and enlarge acquisition. Its integration and funding will be the key rating sensitivity factors. So this says that the company is growing inorganically through acquisitions, and it is likely to grow that way for a long time. And in these turnaround stocks, we don't usually have well, personally, I don't usually have a um long holding time. I usually have the stock for around 3 to 5 years at most, so I don't have to worry about that as much as, let's say, a guy who's investing in it forever, or like for 10 years. And then you can read this. It basically says low operating margins and all. Why does TeamLease have low operating margins? And that's it. Let's go to this, and you can read risk. You can just search risk up. So leveraging micro trends, risk management. Mhm. We operate in consistently changing environments, hiring new trends. Okay, this is just like an overview. Okay, we can read this too. Labor law compliances, failures to comply, mitigation actions. We can read this to talent retention risk, governance, statutory and compliance, ethical, supply chain stability, market risk adaptability, M&A integration. So basically, they listed a few of the risks here. So now I think I've gone through the risk section, and now we should go to the valuation. Okay. Okay, so now let's head over to the valuation section. So as we can see, we already did two valuations. One we did from the P's, two, and then we did this. Okay. Now we're gonna go to profits, and let's see how much did increase. It nearly. Okay, let's see. Mm, 80, 83. Okay. Uh, and then now we're gonna. So now you've noted the profit and how much did it increase. 5 year, 24% return from 5 years. Compounded profit growth is 24%. Okay, so now we're just gonna come here. That is the closing price is 37.80, but since it is a little high, what we can do is to get a conservative estimate. What we can do is we can plot something from the COVID crash. We can do something like this, and then we can take the half of this. So that's gonna be 2174, and then we're just gonna go to CAGR calculator.net reverse CAGR calculator.net. Our starting value was 2180, right? 2174, sorry, 2174. Our CAGR is 24, and how many years? We did 5 years. So it would come to this much. Okay, 6373. That's our profit CAGR, profit valuation. That's basically a basic assumption of a profit valuation. I didn't do the full valuation because that would take me at least an hour to do it. But if we do the full valuation, the value would come around here. Just draw you a circle. So the value would come around here, anywhere from there to there. Okay. So that's basically okay. So let's just do a conservative estimate. Okay, first. So our median, so our base case scenario is that within the next 3 to 4 years, we see a movement from here to there within the span of 3, 4, maybe in 5 years. Our bear case scenario is we see a movement around here, and our bull case scenario is we see a movement from anywhere in between of 4953 and 6378. Okay, this is our these are our bull case, base case, and those scenarios. And I think, and I don't know how much drawdown will it happen, because there are two things we can't be sure of. We can't be sure of volatility and the holding period. So I'm not sure if it will go down 50% and then come up to this, or it will just go up straight to this. I don't know that. And again, this is not financial advice. This is just for education. And yeah. So in short, I just I think this is a buy for me. For a conservative to a mild risk investor, I would wait for the stock to form a W pattern or something that suggests the stock reverses. So something like this, and then it will go up, or maybe something like this, and then it will go up from here. Something like this. I would for a mid risk investor, I would suggest that to wait for a reversal pattern. Anyways, this is it from my side. Please, please subscribe to my channel. We are a relatively new channel, so anything would help us right now. Please like this video, comment, and share it with your friends. Thank you, appreciate it. Have a good day, guys.